4.3 Net Asset Value Approach examining BCG's balance sheet components. Goodwill, $39.8 million, significant portion of assets. Tangible book value, likely negative given accumulated deficit of $22.9 million. Liquidation value, potential discount to stated book value due to intangible assets. The company trades at a significant discount to its stated equity value, but much of this value is comprised of goodwill rather than tangible assets. 4.4 Valuation challenges and considerations. Valuing BCG requires careful consideration of several problematic factors. Inconsistent earnings. Unpredictable profitability makes cash flow projection difficult. Goodwill impairment. Risk. $39.8 million in goodwill may be at risk of impairment if acquired entities underperform. Industry multiples. The wealth management industry typically trades at higher multiples, PS of 4 to 12x. Suggesting BCG's 0.15 Ps reflects significant market skepticism. Based on available data, BCG appears significantly undervalued based on Morningstar's quantitative model, but fairly valued or overvalued based on fundamental earnings power and asset quality. 5 Long-term prospects and risks. Evaluating BCG's long-term potential requires examining industry dynamics, competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The wealth management industry presents both opportunities and challenges. Market trends. Growing demand for financial advice due to demographic shifts and wealth transfer. Competitive pressures. Intense competition from both traditional firms and emerging fintech solutions. Regulatory environment, increasing compliance costs, and regulatory complexity. BCG, as positioning as a consolidator of independent broker-dealers, addresses fragmentation in the industry but faces significant execution challenges. 5.2 Competitive threats and market position. BCG faces competition from several fronts. Larger wealth managers, established firms with greater scale and resources, fintech disruptors, technology-driven platforms with lower cost structures, independent RIAs, growing movement toward complete independence from broker-dealer networks. BCG's competitive position appears challenged due to its small scale relative to major players and lack of distinctive competitive advantages. 5.3 Key risks and challenges. Several risks could impact BCG's ability to compound capital over the long term. Profitability, sustainability. Inability to achieve consistent profitability despite revenue growth, debt burden. High leverage relative to earnings capacity. Integration risk. Challenges in successfully integrating acquired firms. Advisor retention. Potential for advisor attrition to larger platforms or independent models. Regulatory changes. Increased compliance costs could further pressure margins. 5.4 Capital compounding potential for BCG to compound capital effectively over the next decade. Several conditions must be met. The company must achieve consistent profitability with returns above cost of capital. Successful integration of acquired firms must generate promised synergies. The advisor retention rate must improve to stabilize the revenue base. Debt reduction must continue to improve financial flexibility. If these conditions are met, BCG has the potential to benefit from industry consolidation trends. However, the uncertainty around these factors makes the company's long-term prospects highly speculative. 6 Final verdict. Buffett-Style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how Binah Capital Group measures up against each of the key criteria. A. Understandable business. BCG operates in the financial services industry, which is reasonably understandable. Their model of consolidating broker-dealers is straightforward to comprehend. Rating: satisfactory. B. Consistent earnings. BCG has demonstrated inconsistent earnings with recent quarterly losses and negative ROE. The company has not achieved consistent profitability. Rating: poor. C. Good ROE, ROIC. BCG's ROE of -256.60% and ROIC of -8.62% fall dramatically below Buffett's typical threshold of 15% plus. Rating: very poor. D. Low debt. While debt has been reduced, Company's interest coverage ratio of -0.38 and high debt relative to earnings remain concerns. Rating: poor E, attractive valuation. The stock appears statistically cheap on PS basis, but may not be truly undervalued given profitability challenges. Morningstar's fair value estimate suggests upside, but with high uncertainty. Rating: mixed. F. Long-term moat. BCG's moat score of 1/10 indicates very weak transient advantages with no sustainable competitive advantages. Rating: very poor 6.1 overall assessment. Binah Capital Group does not meet most of Warren Buffett's investment criteria and would not qualify as a Buffett-style investment. While the business model is understandable and the stock appears statistically cheap, the lack of consistent earnings, poor returns on capital, weak economic moat, and financial leverage concerns make it unsuitable for a traditional Buffett-style investment approach. The company might be appropriate only for speculative investors who believe in the consolidation thesis and can tolerate high risk. However, for investors seeking Buffett-quality investments, there are likely better opportunities elsewhere, with stronger competitive advantages, more consistent earnings, and higher returns on capital. Table: Binah Capital Group Buffett-style investment suitability, summary criterion, assessment, explanation, understandable. Business satisfactory, financial services consolidation model is comprehensible. Consistent earnings, poor, inconsistent profitability with recent quarterly losses, good ROE. ROIC, very poor ROE, -256.60%. ROIC, -8.62%, well below 15% threshold. Low debt. Poor improving but still problematic interest coverage, 0.38. Attractive valuation, mixed, statistically cheap, but may reflect fundamental issues. Long-term moat, very poor moat, score of 1/10 indicates no durable competitive advantages. Overall suitability not recommended, fails too many key criteria for Buffett-style investment. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. BCG's financial profile presents a mixed picture when evaluated through these lenses. 3.1 Revenue growth and profitability. BCG has demonstrated inconsistent revenue growth with concerning profitability metrics. Revenue performance: Q1 2025, $49 million, 18% year-over-year growth. Q2 2025, $42 million, 2% year-over-year growth. 6-month 2025, $88.70 million, approximately 10% composite growth. Profitability challenges. GAAP net income, Q1 2025, $1 million, Q2 2025, $0.7 million. Gross profit margin improved to 21% in Q2 2025, $8.8 million gross profit, but remains thin relative to revenue normalized ROE, -256.60%, extremely poor. Normalized. ROIC, -8.62%, failing to meet cost of capital. 3.2 Debt levels and financial health. From a balance sheet perspective, BCG shows moderate improvement but ongoing concerns. Debt reduction. Long-term debt decreased from $25 million March 2025 to $18.6 million. June 2025, liquidity position. Cash and equivalents of $8.2 million. June 2025, provide limited buffer leverage. Ratios. Interest coverage, -0.38, indicating inability to cover interest expenses. Current ratio, 0.83. Potential short-term liquidity concerns. 3.3 Free cash flow generation. Specific free cash flow figures are not provided in the search results, but the company's thin profitability and negative ROIC suggest weak cash generation relative to invested capital. Table: BCG Financial Health Assessment 2025. Financial metric status: Buffett, standard assessment, revenue growth 10%. Composite 6-month. Consistent growth, moderate. Profit margins approximately 2%, net margin inconsistent. Consistently profitable, poor ROE, normalized, -256.60%, 15% plus, very poor ROIC, normalized, minus 8.62% greater than. WACC, very poor debt. EBITDA, approximately 18.6x based on $1 million EBITDA. Minimal debt, poor interest. Coverage minus 0.385x, very poor for intrinsic value estimation. Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life rather than prevailing market prices. Estimating BCG's intrinsic value presents challenges due to its inconsistent earnings and profitability issues. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to BCG is complicated by its unpredictable earnings and negative cash flow patterns.
However,
We can examine various valuation metrics. Market-based metrics. Price-sales ratio. 0.15, significantly below industry average. Price-normalized earnings. 18.02 market. Capitalization. $26.73 million Morningstar quantitative assessment. Fair value estimate. $8.29. Current price. $1.61 theoretical upside. 415% based on these figures, however. The high uncertainty rating from Morningstar and the company's operational challenges suggest this fair value estimate may be overly optimistic. 4.2 Owner's earnings approach. Buffett's concept of owner's earnings. Reported earnings plus depreciation, amortization, certain other non-cash charges minus average annual capital expenditures is challenging to apply to BCG due to its inconsistent profitability and limited disclosure of capital expenditure patterns. Comprehensive analysis of Binah Capital Group BCG. Through Warren Buffett's investment lens 1, business quality, and economic moat. Analysis Binah Capital Group, NASDAQ. BCG operates as a financial services aggregator in the wealth management industry, specializing in consolidating independent broker-dealers and registered investment advisors under a unified platform. Founded as Wentworth Management Services and rebranded following a SPAC merger, the company has built a network encompassing over 1,900 registered professionals across 500 offices in all 50 U.S. states. Their business model focuses on acquiring established firms and leveraging economies of scale to provide back-office support, technology, infrastructure, and compliance resources to financial advisors who operate with varying degrees of independence. 1.1 Revenue model and business operations. BCG generates revenue through a diversified stream centered around the financial advisory ecosystem. Commission-based revenue, primary source. Generated from transaction fees on investment products sold through their broker-dealer network. Contributing approximately $75.1 million in the first half of 2025. Advisory fees, recurring revenue from assets under management AUM, which reached $28 billion in Q2 2025, 11% year-over-year growth. Insurance and other fees, supplementary revenue from insurance product sales and other financial services. The company's hybrid-friendly platform allows advisors to operate under multiple models, dual-registered, independent or W-2 employees, creating flexibility that enhances advisor retention and acquisition. 1.2 Competitive advantages and economic moat. Scale and network effects. With $28 billion in AUM and a nationwide advisor network, BCG achieves operational efficiencies that smaller competitors cannot match. This scale allows them to negotiate better clearing arrangements and technology partnerships. Multi-brand strategy. By maintaining multiple broker-dealer brands, including Persh Kaplan, Sterling Investments, and Cabot Lodge Securities, BCG can preserve brand loyalty while capturing back-office synergies. Technology integration. The company has invested in technology-enabled regulatory compliance and advisor support tools. Those specific proprietary advantages are not detailed in available sources. Despite these strengths, independent analysis from GuruFocus assigns BCG a moat score of 1/10, indicating very weak transient advantages. The assessment notes that BCG operates in a highly competitive financial services sector with no significant market share or unique intellectual property, and lacks strong brand strength, customer loyalty, or regulatory advantages that would provide a sustainable competitive edge. Table BCG's economic moat assessment using Buffett's framework moat component, BCG status assessment. Brand value, multiple established brands but no dominant industry brand. Weak cost advantage, some economies of scale and operations moderate. Switching costs, advisor retention through platform flexibility, moderate network effects, large advisor network, but limited data advantages, weak. Intangible assets, no significant patents or regulatory barriers, weak to management quality assessment. Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. BCG's leadership team demonstrates several characteristics that align with Buffett's preferences. Though some aspects warrant concern: leadership experience and track record. CEO Craig Gould has led the company through its transition from Wentworth Management Services to Binah Capital Group. Under his leadership, the company has achieved 18% revenue growth in Q1 2025, and improved EBITDA from break-even to $2.2 million. Gould emphasizes an advisor-centric platform and highlights strategic acquisitions, like Bleakley Financial Group, as evidence of growth initiatives. Capital allocation strategy. Management has demonstrated a mixed approach to capital allocation. Debt management. Reduced long-term debt from $25 million. Q1 2025 to $18.6 million Q2 2025, showing focus on balance sheet improvement. Strategic acquisitions. The acquisition of Bleakley Financial Group demonstrates growth through acquisition strategy, though integration effectiveness remains unproven. Shareholder returns. No dividend payments, with capital primarily reinvested in operations and acquisitions. Shareholder alignment. Institutional ownership has increased. Vanguard Group adding 78,329 shares, plus 187.1%, and UBS Group adding 21,312 shares, plus 47.9%. In Q1 2025, however, specific information about insider ownership and management compensation alignment is not provided in available sources. Transparency and communication. Management provides regular quarterly updates with detailed financial disclosures, including GAAP and non-GAAP metrics. However, the company's communication tends to emphasize non-GAAP metrics like EBITDA, which may obscure true economic performance. Despite some positive aspects, the company's negative return on equity, 256.60%, and inconsistent profitability raise questions about management's capital allocation effectiveness and operational execution.